Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at three companies. There's a bonus one at the end of this video, so definitely check this out. Companies that have been giving at least 100 years of dividends to its investors. These are well-established companies that you probably use for goods and services. In my opinion, these are recession-proof companies, and they're undervalued, as well as their analysis rating of strong buy and buy. So if you're interested, sit back, enjoy the video. Do me a favor and like if you haven't done so and you're not yet a subscriber. Hopefully at the end of this video you will subscribe. It really does mean a lot to me. Also remember, this is not financial advice. This is just me sharing. Without any more delays, let's take a look at this company. So the first company I want to talk about is none other than Johnson & Johnson. Ticker symbol is JNJ. If you're not familiar with Johnson & Johnson, they are companies that you probably use for consumer health products, such as you can see from there. They also do med tech as well as medicine. So one of my favorite companies, solid companies in my opinion. Now let's take a look at Simply Safe Dividend. Based on their dividend safety score, they rated as 99, which is very safe. You can see the dividend yield is 2.77. It's a little bit higher on the 5-year average. Market cap is a mega cap. And then if you look at the key metrics, you can see payout ratio is 43. During the recession, they have increased it. And then look at that, 106 years without a reduction. Going down further to the dividend growth, payout in the last 20 years, 9%, last 5 years, 6%, and then the latest is 6.6. And then look at that beautiful upward trend. Again, this is the main thing, 106 years of dividends without a reduction. That's just amazing. Dividend growth for the last 59 years, consecutive increases, so even another accomplishment. Payout details, if you're wondering, quarterly in the months of March, June, September, and December, and the annual payout will be $4.52 per share, which breaks down to about $1.13. Now if we look over here, you can see the sector PE 16, and then Johnson & Johnson. It is under the high of 186. Again, the low is 155, so you're getting it pretty cheap in my opinion. Now looking at some of the metrics in here, you can see total sales, return on investment capital the last 12 months, 22%, return on equity, 25%. Now let's swing over to Simply Wall Street. Based on their valuations, you can see right here. I want to look at the share price versus fair value. So versus the share price and fair value. Fair value rated as 206 at the time that this video is 163, and calculated about 37% undervalued. Now if you look at some of the dividends, you can see right here, stable, and then you can see the evaluation, country, the overview. As you can see here as the positives, earnings are forecast to grow 4.4% per year. They have grown 19% over the last 5 years. And then here's the risk, one large impact results. So let's take a look at tip ranks at the time of this video. Again, it's 163. Rating is about moderate buy, 6 buy, 4 holds. 188 with a 15% upside, and then their highest price target is 215, average is 188, and then 165. Now moving along to the analysis here, outperform of a 10 smart score, and then hedge funds holdings have increased. Now if you look a little bit more, you can see very positive attitude, and then you can see hedge funds increase holdings by 4.4 million shares last quarter. Inside trading, you can see right here, nothing that much. Now let's take a look at NASDAQ based on their analysis. There's 18 of them they rated as a buy, and then here are the people that the firms. You got like Citigroup, Bank of America, you got Wells Fargo, Zach Research, and then they also kind of like similar, a high of 215, 188, and then a low of 165. Second one I want to talk about is Procter and Gamble. Ticker symbol is PG. Again, another iconic, solid company that you probably use on a daily basis. I know I use it because I have kids. These are some of the products you can see, from diapers to fabric care to laundry detergents and paper towel, toilet paper, feminine hygiene, pretty much every oral care and all that stuff. Now let's take a look at Simply Safe Dividend. Based on their dividend safety score, they're rated as a 99, which is very safe. Dividend yield is 2.89, another market cap, mega cap. Payout ratio 61%. They have increased their dividend during the recession. If you look at the dividend growth, the last 20 years, 8%, last 5 years, 5%, and then the latest 5%. 5%. Again, pretty similar to Johnson & Johnson. Look at that. Go solid increases throughout the year. But look at this. Wow. 132 years without a reduction and 66 years of consecutive increases. Again, another solid company. Based on their payment details, you get paid quarterly in the months of February, May, August, and November. Your annual payout will be $3.65 per share. Breaks it down to about 91. And then you got your right here. So looking at the 52-week, the high is 164 and then the low is 126. So you're getting it in the low end. And then you get your sector PE ratio right here. And then return on investment capital, 22%. Return on equity, 32%. Swinging now over to Simply Wall Street. Based on their share price and fair value, 219 is the fair value. It currently is at 126. They calculated about 42% undervalued. If we go now to tip ranks, moderate buy, 11 rating, 6 buy, 5 holds, 154 with a 22% upside, and then your high is 175, 154, and then 125. Now if we go to some of the analysis, neutral, and they have decreased their holdings. You can see hedge funds, their added confidence signals about negative. Insider trading, they have sold it. Now swing over to NASDAQ. Based on their analysis, 14 of them they rated as strong buy. And then these are the companies like Barclays, Bank of America. You got Morgan Stanley, JP Morgan. And then you got your price target of 154 with the high of 175 and then the low of 125. And then the last one I want to talk about is none other than Coca Cola. Ticker symbol is KO. This is a company that engages in manufacturing and sales of, soft drinks, water, beverages. So another iconic brand. Now, if we go to Simply Safe Dividend, dividend safety of 80, which is safe. Dividend yield is 3.14. Another mega cap. You can see again. Key metrics, payout ratio 70%. During the recession, they've increased it. And then look at that. Dividend streak of 102 years without a reduction. And then last 20 years, 8%. Last 5 years, 4%, which is slow. The latest is 4.8, which is also slow. Upward trend, I really like to see that. Uninterrupted dividend streak, again, look at that. 102 years without a reduction. And then 59 years of consecutive increases. During you get paid quarterly in the months of April, July, October, and December. Annual payout is $1.76 per share. You can break it down to about 44 cents, yeah. Now looking at some of the stats, and here you go. Return on investment capital 17%, return on equity 39%. We go to simply Wall Street. Fair value is 88, 56 is current, and then you got a 36% undervalued. Switching over to NASDAQ, strong buy based on 16 of them. And then you got like this pretty much Citigroup, Zach Research. And then here is your price target of 70 with the high of 76, average of 70, and then the low of 65. Now if we go to tip ranks, they rated as a strong buy, 9 buys, 3 holds, 25% upside, 76 is the highest, 70 is the price target, and then 65 is the lowest. If we go to the smart score, they outperform of 8. And then hedge funds have decreased their holdings. And then insiders have sold shares in the last 3 months. So, and then the final one that I want to talk about is York Water Company. So this is a company that engages in distribution and purifying of drinking water. So not many, I think, know this company, but it seems to be a company that has been giving at least 100 years of dividends. So let's take a look at the dividend safety score based on Simply Safe Dividend. Based on their dividend safety score, they rated as safe, which is 80. Dividend yield is 2.03. It is a small cap. And then you can see here payout ratio is 59. During the recession, they have increased it. And then look at this. The dividend growth has been slow. So it is one of those boring, slow companies, but I guess the dividend is pretty solid. Last 5 years, 4%, which is slow. You can see from the chart, it's just slowly stuff, but look at this. Wow. 206 years without a reduction. That's just amazing. And dividend growth streak of 25 years consecutive. And then your payout details would be in the months of January, April, July, and October. Annual payout would be 78 cents per share, which breaks down to about 19 cents. Now, if you look a little bit more down, you can see some of the stats. Return on investment capital, look at that, 6%, and then return on equity is 10% right here. If we go over to tip ranks, outperform, hedge funds have increased it, and then you can see from right here, hedge fund increased holdings by this amount of shares last quarter. Looking at NASDAQ, you can see strong buy, and it's only one person. It's only one company that bought it. All right, guys, there are your companies. All of those are solid companies to invest on, especially during this time where the market just seems to go up one day, go down one day. These are companies that are going to continue to be resilient, companies that everybody probably uses. So yeah, it's definitely something to consider if you haven't been investing on. Thank you so much for watching. Hope you like this video. If you do, give it a thumbs up. There's also other videos to check out if you're interested in other dividend companies. Stay cool, but everyone, please be safe out there. Stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.